Hello. I'm just making sure that everybody connects. You may be wondering why I don't have a mask. And that's because our moderator is had a commitment and couldn't be here. So I'm all by myself in class. Typically we have a student that joins in person, but not today. And so yeah, so I have the luxury of be mask free, which is, you know, I mean, it's nice in a way. Obviously I would, if I had to trade between having you here and wearing a mask, I would choose having you here. But you know, this is teaching at the time of nothing we can do. All right, so good afternoon, everybody. It is Friday, October the 16th. I think this week marks officially our mid-semester, right? I think so. It's week 7. I don't know where you are, but here in Boston is rainy, not pleasant, but it was nice this morning. And yeah, that's accounting we are in accounting 221, and we're going to talk about long-term assets. How you guys doing? Doing okay? Hanging in there? Yeah? All right. You know, any story about COVID-19, or not COVID-19. We don't want to hear any more stories about COVID-19, but I mean like any story of silver lining of this situation. Please feel free to share at the beginning of class. Today with the other class, I shared my silver lining story, which is I live in Boston. I'm a Boston resident, and I commute typically with the T here at the university, but obviously because of COVID, I don't feel comfortable. And so I decided to bike, and it's a wonderful bike ride, which I'm getting very much used to, and I'm enjoying it all the time. And it's a bike ride through the Esplanade, so it's really nice, really relaxing, and it's like my way of treating myself during this period of you know, COVID. So, but if you have any stories about like how you are sort of silver, like what is a good, you know, I suppose a good thing about this whole madness, let's call it like the right name, feel free to share. I do like the element of remote in a way, because I think that gives students the sort of the liberty of managing their time a little bit better. But you know, like I said, if I could have you in class, that would be my gift for Christmas. Having one full class, like a class with people, but there's just so much we can do. But again, if you have you know, any nice story at the beginning of class, feel free to share. We would like to hear from you, so we don't have to talk only about accounting. So, but talking about accounting, so today we're going to continue our conversation on long-term assets, and which we're going to continue also next week. And long-term assets will be part of your exam. And next week, what I'm going to try to do is send a survey, like have you do a survey during class time, to talk about, you know, like what you guys think about the week of before Thanksgiving, if you want to do 2 classes in one, if you have that flexibility. And like I said, I don't have a preference. I'm in Boston. I'm staying in Boston. I'm not going, excuse me, anywhere. And I don't mind coming in. I'll probably come in anyhow on Monday, but I almost feel like, especially for a group like this one, where like the majority of you is on Zoom, I suppose that's what you do also for your other classes. I think that having a good break from Zoom, it's a good idea. But again, let's see what we can get out of that survey. And if it's not feasible, it's not feasible. At least we tried. All right. Some people told me that they didn't like the idea of having 100 minutes of accounting. I get that part. There are worse things in life, you know that. I mean, like, but we will have a break and everything, I promise. It's not that would be 100 minutes of accounting straight. That would be atrocious for me too. That I can't talk for that long. But yeah, so we'll discuss that more. Alrighty, so without further ado, and having the virtual presence of everybody, we're gonna start class. All right, so we talked about long-term assets last class, and there are just a few, as usual, I tried to point out to you a few salient points, a few slides that make sense to think about when we talk about long-term assets. And the first one is certainly this. I mean, like we talked about long-term assets, tangible versus intangible, property. So my tangible assets are property, plant, and equipment, and I'm trying to annotate. So property, plant, and equipment, natural resources, and land. And one thing, guys, is like, I don't want you to, you know, think that you're going to find natural resources and land in in all the financial statements that you're going to review. I mean, certainly you're not going to find natural resources if you review the financial statements of a retailer. They don't have natural resources, to the best of my knowledge. So those are like how you can classify them. But I remember vividly one student a couple of semesters ago who told me, raised their hand and said, I don't think this is accurate because if I go, I can't remember if it was Starbucks or some other company. They're like, but it was it was a retail business. You're like, I don't see natural resources. I'm like, that is a great observation. However, like, and that sort of things like make me think about that. I have to remind you guys that you're not going to find all of them in all the financial statements. You'll find PP&E for sure. Most likely you'll find land, although that's debatable too, but certainly you're not going to find natural resources in all the financial statements. So PP&E are depreciated. And we're going to discuss today straight line method. And depending on time, we might get as far as double declining, but certainly we will discuss units of production next class. Then there are, and again, the depreciation is applicable, like we use the term depreciation for property, plant, and equipment. For natural resources, we talk about depletion, and land is neither depreciated nor depleted. Then we talk about intangible assets that don't have like a physical presence, and the intangible assets could have an identifiable useful life or an indefinite useful life. Here you have some examples: patent, copyrights, or an indefinite useful life, goodwill. For the items that have an identifiable useful life, we amortize them. So again, something to keep in mind, that the verbiage that we use. Again, depreciation is used for property, plant, and equipment. Depletion is used for natural resources. Amortization is used for intangible assets with an identifiable useful life. Another slide that I want you to know inside and out for, certainly for the purposes of this class, but also in general, is this one over here. I know I've been pulling up this slide over and over and over again since the accrual a chapter, but this really gives you a sense of like, what is a cost? A cost is a cost, but if I use the resource that I purchased in the immediate and doesn't have any future value, that is an that cost becomes an expense. Otherwise, that cost becomes an asset, and because as future benefits, and as I use that asset, I book it as an expense. So something to certainly keep in mind. So which costs should be capitalized? We talked about, again, purchase assets, and the costs capitalized are invoice prices, freight, installation, legal fee, taxes, testing and costing, and so on. And then there are self-constructed assets, the ones that the company builds internally, where we capitalize the materials, the labor, and some amounts of overheads. Also, we can capitalize the interest costs associated with financing that specific project. And again, I'm not going to go in depth of this just because we have discussed this at length last class. It's just a way to ease into the material of today. Then we made the example of what if I purchase an asset? What cost am I going to capitalize? So in this example over here, guys, we have the machine purchased at 920. So Red Terrier purchases a new printing press, and it is purchased for 920. The transportation of the machine is 62K. The payment of the insurance is 10K. The testing is 5, and the maintenance cost is 4K. However, it's an annual fee. It's an annual service. So the idea is that I need to think about costs that allow me to assure that the resource is useful for more than one fiscal year. So the payment, like the actual price of the printing press, certainly serves that purpose. The transportation of the machine, unless I pay the transportation of the machine, I am not going to have the machine in my premises. Hence, I'm not going to be able to use it over time. So incurring that cost allows me to use that machine for future periods. Similarly, the insurance. If I don't insure my machine and my machine gets damaged, I'm not going to be able to use that machine for future periods. So that's why that cost is capitalized. And same thing with testing. Unless I test the machine for the use that I want to, for the intended use, then I won't be able to use it in the future. It won't have future benefits. Hence, I capitalize that cost. Maintenance, though, I don't capitalize it, because if I don't do maintenance this year, I still have to do the maintenance for the next one. So the maintenance of the year 2020 is as good as, as good as it is for the year 2020, has no value for the year 2021. Therefore, I don't include it in my purchase, in my assets. I don't include it as part of my long-term assets. That cost gets expensed right away. So therefore, the total purchased asset is capitalized for 997K right here. And so my cash increases, my assets increase and my cash decreases, or my payable decrease, depending on how I pay for this asset. Now, let's think about self-constructed assets. Red Terrier is constructing a new production facility with expected completion on December 31st, year 2. During year 2, Red Terrier pays $2 million for materials, $500K for architect and labor, zoning and inspection fees for $75,000, and then interests of accrues interest of 10% on $2 million, which are pretty much $200,000. What is the value of the PP&E? It's really all the above, because they all have, they're all instrumental for me to have a future benefit. The cost of the material is, the cost of the architect and labor Unless I pay them, I'm not going to have a construction that I can use over time. The zoning, unless I get that inspection, I'm not going to be able to have the building up and running. Same thing goes for the interest. Unless I get that money for that specific project, obviously, I can't have the future benefit. So therefore, therefore the journal, we capitalize all of them, all the costs that we incur in this case, and the total value of my asset is 2.7 million, 2,775,000. So this would be my journal entry. Now, what is the, again, that's when I purchase or when I build an asset. What if I have additional spending on an existing asset? That additional spending is capitalized when the results of the spending increases the capacity of the machine or extends the useful life. It's expensed when the asset's capacity or the useful life doesn't change. Think about the maintenance. But if it was a maintenance, if it was a repair, if it was a replacement, say the printing press, if I have to basically replace one of the main parts of the printing press, that is a spending that increases the capacity, because otherwise the machine would be damaged. And most likely increase the useful life, because imagine if you replace one of the parts of the printing press and now you have a brand new part that can give you so much more printing than the previous machine just because it's brand new, then automatically you'll have an extended useful life. Whereas on the other hand, if you are doing just the maintenance, the $4,000 maintenance, I think it was $4,000 maintenance, then it's just, that's it. I mean, it's good for 2020, but it's not going to be good going forward. So what would be, so speaking of maintenance, what would be the journal entry for the maintenance? Again, maintenance doesn't increase the capacity of the extended useful life. It's just a way of making sure that on an annual basis, you take care of the machine and you make sure that you keep up with the needs of sort of checking the machine on a regular basis. In the case of maintenance, remember, Red Terrier had bought that printing press. All the costs were capitalized at the exception of the maintenance, which was $4,000. How would I book that $4,000? Increase the expenses, so debiting the expense for $4,000 and decreasing cash, so crediting cash. On the other hand, if I had an improvement, let's assume that Red Terrier in year 3 spends $5,000 in cash to improve the machine's volume of output and extend the machine's useful life, that you can capitalize, because you are improving the future benefits. And so at that point, it makes sense for you to add that $5,000 to your PP&E, to your 997, I believe, was the value of the machine, of the printing press. So you will add additional $5,000 to it. Well, obviously with a disbursement of cash of $5,000. So we talked about acquiring funding. If you recall, last class we talked about you can acquire funds for the machine by issuing a note payable. Then we talked about buying it and what we book as a cost. Now we're going to talk about the usage of the machine. How do we use it? When we use the machine, we can find ourselves, or any long-term assets, we can find ourselves thinking about what are the accounts that I have to use to show the usage of that machine. So on the far left over here of our screen, I have my assets. So for equipment like the printing press, I'm going to think about two accounts: the accumulated depreciation and the depreciation expense. So basically, the two accounts are the ones that sort of measure for me how much I'm using that machine, of that machine. So the balance sheet will tell me, will answer the question of how much I've used of that machine so far, whereas the depreciation expense will tell me how much I've used of that machine for a specific accounting period. Based on what you know, what kind of account is accumulated depreciation? Asset, liability, what is it? Anybody?
Contra asset.
It is a contra asset account. Thank you, Manoj. And so is, you know, like and so are all the accounts that sort of decrease the assets. So if I'm thinking about equipment and building, I am going to have, for that asset, which would be booked in the balance sheet, I'm going to have accumulated depreciation and depreciation expense. If I have land, I have none of the two because land is not depreciated. When I'm thinking about leasehold improvements, do you guys know what leasehold improvements are? Any guess? So today I feel like I made an example that made people laugh, so I'm going to do that again. Leasehold improvements are improvements that you make to properties that you lease. The very typical would be a company that leases a space and then sort of reshapes the space as they want. Or like, think about stores, think about retailers. I mean, if you walk down Newbury Street, if you walk down Newbury Street, you're gonna have a bunch of brand names. And ironically, all these stores will look, you know, like if you look at the store of Cartier, that store will be pretty much the same exact colors, the same exact, in a way, layout of the stores in New York City, the stores in Paris, and so on and so forth. Of course, when Cartier rented that space, it was just a raw space. But then they had to come up with the paneling, with the, you know, with their, with the way they divided the space, with the colors that they wanted to use, with the way they want to sort of think about how to, you know, sort of reshape their windows and all that. That's leasehold improvements. So, you know, I hope that next time you walk down a busy street with stores, you may think about that concept for 5 seconds, because that cost that Cartier incurred will be capitalized. And same thing goes for the company that gets a, you know, a raw space in a building, and then say the company color are red and orange and yellow, then they started up, you know, the painting. I mean, it's not going to be significant enough to capitalize, but then, you know, they start putting walls and like they start like, but they have a whole theme of shapes and colors and that they wanted to use for their company. But not only that, they'll need offices, and they will reshape the space so that they can accommodate their employees. So all those costs will be leasehold improvements, which you capitalize and you expense over time, and you amortize over time. The other, obviously, is natural resources that you can have accumulated depletion and then a depletion expense. Then goodwill is neither amortized nor depleted nor depreciated, but being an intangible, you really want to think whether or not it gets amortized. And then you have other intangibles that work like this, like the amortization. It's either like a reduction of the primary asset. Say you have copyrights, then you amortize the copyright by decreasing the value of the asset as opposed to have an accumulated depreciation. You can do it that way, or you can have I'm sorry, not an accumulated depreciation, accumulated amortization. You can have it like as a reduction of the primary asset, or you can have an accumulated amortization. Frankly, my experience has always been to have a reduction of the primary asset. So that will happen in the balance sheet, but in the income statement, you'll find the amortization expense of the period. So again, keep in mind this table to look at what is that, what accounts you're going to be looking at when you think about depreciation of an asset. And once again, in the balance sheet, I have the acquisition cost, and then like over time, you know, the cost is allocated within the period that it benefits the company, you know, and the amount, we're going to see in a moment how you quantify the amount that benefited a company in a given period, and it's booked in the income statement when it's used. So just to be clear, the depreciation expense is booked, it's a depreciation for the current year and is booked into the income statement, whereas the reduction of the asset is the accumulated depreciation. And the journal entry that you guys need to be familiar with, regardless of the depreciation method, is the one that, you know, it helps you sort of record that depreciation. You can have straight line, double declining units of production. No matter what you have, your journal entry will always be increasing the depreciation expense, increasing the accumulated depreciation. I increase my accumulated depreciation by credit because it's a contra asset account, as Manav said at the beginning of class. And I'm increasing the depreciation expenses by debit because that's what I do as part of the, you know, as my rule of debit and credit. So again, while the depreciation expense gives me the measure of the depreciation on the current year, the accumulated depreciation gives me a sense of what is the total depreciation up to date. How big is my bucket of depreciation? So please keep this, I'm sorry, was there somebody asking a question? Okay, so please keep this slide in mind, and you know, when you do your review. One you know, figure that I really like, I'm a visual person, I like checklists, I like instructions, I like to keep things neat, and I literally learn by, you know, by doodling, by doing my figures and like seeing how things are connected. So that was the purpose why I've prepared, like, you know, I had created this slide a long time ago in this animation. So I have an asset cost less the accumulated depreciation, which is my best attempt to draw a bucket. So don't judge. I was horrible in drawing since I was a kid. This is the best I can do. But it's a bucket. You gotta put some imagination. So in my bucket, each and every year, I increase my bucket, I fill my bucket with depreciation expense. So my bucket is in the balance sheet, and I fill the bucket with the depreciation expense of year one, which will increase my bucket of accumulated depreciation and will also show as a depreciation expense in year one. Year two, my bucket now goes up, still has the depreciation expense of year one, but it's filled also with the depreciation expense of year two. So now in my bucket, I have two depreciation layers, the depreciation expense of year one and the one of year two. However, and instead in the income statement, I'm going to have just the depreciation expense of year two. Does it make sense? Why? I mean, my accumulated depreciation is a permanent account. So it carry forwards the values, and it tells me at that point of time, how much have I used on my assets? Whereas my depreciation expense is a temporary account. It's an account of the income statement. It answers a different question. It answers the question, how much have I used of that asset in this accounting period? So same thing happens for year 3. My bucket now is filled with 3 depreciations, and my depreciation expense of year 3 is only the one that goes into the income statement, is the only thing that goes into the income statement. So the income statements for each and every year will have each and every one of them their discrete amount of depreciation, whereas the accumulated depreciation will be filled, the bucket of accumulated depreciation will be filled with depreciation expense of year 1, 2, and 3. That's why it's called accumulated. So if I take the asset cost less the accumulated depreciation, that will be equal to the asset net book value at the end of year 3. And that will be the value that I have in the balance sheet. Any questions? Okay. So cost allocation, like there are like, when you know, we kind of avoided this question so far, but now we cannot go any further. When we think about the depreciation, we need to think about answering 3 questions. What are what do we mean by useful life? How do we decide the useful life? And what is the expected useful life for a machine? What is its salvage value? The salvage value is basically, like the residual value that you attribute to one long-term asset, and at the time you're not going to need that long-term asset anymore. So once you're done, the useful life that you estimated is over, then you want to know what is left, what is the residual value left that you could potentially sell that asset for. Think about company cars, like a fleet of company cars that the company uses for employees that need to travel, so that the employees don't use their own cars and don't depreciate their own cars. So I can I can decide I buy a car for $30,000 and I'm not going to keep it for more than 5 years, and I'm going to sell it 5 years from now for $7,000. That's a salvage value. So you're saying you're going to be using that car just for $23,000 worth of value, because the $7,000 will be how much you're going to sell that car for. The other thing that we need to establish is like, what pattern of depreciation we'll be using: straight line, double declining, units of production. What are we using here? So to answer these questions, how do we determine the useful life? It's typically requires like a management judgment, and also because the company will decide how much am I going to use that asset for. And the very same asset, guys, can be can have a useful life of X for one company and Y for another, depending on the use. Then when you go in real life, you're going to find that companies try to sort of be standardized on the useful lives, but that's that's a norm, that's just a preference, but it doesn't have to be like that according to the generally accepted accounting principles. Obviously, the useful life doesn't have to equal the physical life. Make the example of the car. If I want to sell it when it has a value of $7,000, the useful life is going to be how much I'm going to be using of the car, not how much the car is going to last before it dies on me. Then determine the salvage value, if any, because you may not have a salvage value or you may want to use it all. The other thing that you're going to find is that companies have tons of assets that have a net book value of 0, not because they paid nothing for them, it's because they're fully depreciated, but they're still in good condition and they're still used. So Also, the salvage value requires managerial judgment because it's also based on like what is my useful life. And the salvage value, again, is typically how much I'm thinking that I'm gonna sell the item for net of any disposal cost. The depreciation base, on the other hand, tells me how much am I gonna depreciate of the item. In the case of the car, 27,000. The cost is 30,000 minus the salvage value of 7,000. My depreciable base is 23,000, which means that I cannot depreciate the asset past the $23,000, which is a very important consideration when we talk about double declining methods and units of productions. And so the depreciable base is really what portion of the cost is being depreciated. So the depreciation method, straight line method, accelerated depreciation or declining balance, and units of activity or units of production. The straight line method tells me I'm going to depreciate the same amount for each and every year. So the depreciation expense doesn't change, it's always the same over time. The accelerated depreciation depreciates more at the beginning and less or zero at the end. So you take a larger amount of depreciation expense at the beginning of useful life and almost zero or zero toward the end. Typically, this is used for tax purposes, but you can also see companies using it in parallel for the financial statements. Then units of activity or units of production is really like you don't think about how much is going to be my depreciation and I make a prediction. You wait and see the actual results. The company car, for example, I'm going to come up with a depreciation rate, which is the total cost divided by like how many miles I think I'm gonna drive of that car. That will be my depreciation rate. Then every month I'm gonna check how many miles I've driven and apply that depreciation rate to the actual miles, and that will give me the units of production. We'll go through a numerical example next class, but I just wanna give you a sense of how, while you can predict the trend of straight line and accelerated depreciation, you cannot really predict the trend of unit of activities. The firm can use multiple methods with different methods used for different types of assets. Meaning like you can use double declining for one type of assets, you can use straight line for others, or use units of activity for something else. So straight line. Any questions so far? Yeah. Does it resonate as does it make sense? Okay, I'm going to take that as a yes, I suppose. But so straight line allocates an asset to future period equally across the useful life. So this is what I use, all the majority of companies use in the US, but even in other countries. It's really pretty much the depreciable base, as we know, is acquisition cost minus salvage value. The depreciable rate per period is 1 divided by the useful life. So if I have a useful life of 4 years, how much is my depreciation rate?
4.
Say that again.
1/4.
Which is?
1/4.
Yeah, no, as a percentage, as a rate.
25%.
25%, yeah. So we need that depreciation rate because it's going to be very useful when we talk about the double declining method. But really, one thing that you guys need to learn inside out, I mean, you can't expect to do the exam without knowing the last formula, which is the depreciation expense of the period equals your depreciable base, hence acquisition minus salvage value, divided by the useful life. That will give you how much is your expense of the period. So let's assume that UHaul acquires a truck for its fleet at $95,000 and expects it to rent it for 3 years and sell it for $5,000. What is my depreciable base? Anybody?
$90K.
Christina, how did you come up with the 90K?
Acquisition cost is $95K minus salvage value is $5K.
Yeah. 95K of acquisition cost minus 5K of salvage value. That gives me the 90K. What is the depreciation expense of the year? What do you guys think? That was the formula that I asked you to sort of keep by your nightstand going forward because it's going to be useful for your exam. So it's the depreciation base, the depreciable base divided by the number of the years. So it would be 9. I'm sorry, somebody said something.
Is it 30?
It is 30. Well, yes, because it's the 90K divided by the 3 years equals 30K. Where does the 90K come from? The depreciable base. Okay? I mean, you're gonna find this as exercises in your homework, but this is really the basic. So each and every year, the company will depreciate 30K. And so if I'm thinking about it, the depreciation will be like this, the same amount over and over and over again for the 3 years, obviously. And that's a fairly important concept. And here you go. That's how you come up with that. How do I book that? I have, remember, I have the U-Haul, was pretty much like I have an increase in PP&E, so debit the PP&E for 95,000, credit cash for 95,000, so cash goes down, PP&E goes up. At the end of the year, I want to record the adjusting entries for depreciation. What do I do? You have to make a guess. So I'll need some other T accounts here. Sorry, I need to make sure. Here you go. So what do I do there? What would be the journal entry? What is that? How do I memorialize the fact that I'm depreciating this asset? I'll need an accumulated depreciation account, which is a contra asset. And I will need a depreciation expense account. Sorry, trust me, I know how to write better than this. Not even my son in first grade, but this is like me writing in vertical. So what happens in these two accounts? Remember, the depreciation of the year is 30K. does my depreciation increase or decrease? My depreciation expense increase or decrease?
It increased.
So do I debit or credit it?
Debit.
I would certainly debit that. So I will debit in using a blue color by 30K. Okay, what happens to my accumulated depreciation?
It goes up, so you credit it.
Correct, by 30K. That's the journal entry. What is now my net book value of the asset? The net book value is the PP&E, is the combination of PP&E and accumulated depreciation. So what is my net book value?
$65K.
How did you get there, Christina?
Acquisition minus accumulated depreciation. So
Yeah, it would be the 95K minus the 30K. Oops, sorry. Equals 65K. And that will be my net book value of the asset after year one. So notice the depreciation expense will go in my income statement. The accumulated depreciation will go in my balance sheet and will reduce the net book value. That's how you do it. And this is true from for one, this is true for like year one, for year two, what have you. Obviously, year two, you'll have, like I said, you'll add to the bucket. So after year two, how much is my accumulated depreciation? Let's assume that this was, now we are at year two. So let's cross this off. This is now year two. And now let's assume that I have my accumulated depreciation here and my depreciation expense.
Would it be 60?
Absolutely. So I will have a beginning balance of 30K. And I will add the depreciation of the year. I'm sorry, that is so funny. I am debiting the accumulated depreciation. Isn't that funny on a Friday afternoon? So it's 30K, my beginning balance. And then I have 30K of depreciation of depreciation expense for year two. So I have a total of 60K. Do I have a beginning balance for my depreciation expense of year two? Tricky question. Let me help you out with this. Is depreciation expense a temporary or a permanent account? And by temporary account, I mean an account that measures only the performance of a period. So it zeroes out at the beginning of each and every period, whereas every accounting period, whereas the permanent accounts are the ones like accumulated depreciation that carry over the value year after year. And in this case, you are increasing it over time.
Isn't it temporary?
Is it a temporary? So will it have a beginning balance?
No.
No, not at all. So I am going to debit depreciation expense by 30K. And that is the depreciation expense of year two. Which I am going to book into the income statement of year two. So I'm sorry. There you go. So let's do this again. Income statement of year two. So in year one, I had in the income statement the depreciation expense of year 1, and in year 2, which was 30K, and in year 2, I have another 30K. But in the balance sheet, I have an accumulated depreciation that is 60. So let's do this again. What is my net book value at the end of year 2? Used to be 65. Now how much that is?
35?
35. It's 95 minus 60. Now it's 35K. Does it make sense? Okay. This is golden, guys. I mean, this concept is extremely important. Understanding what happens into the income statement, which is really, if you think about like a, you know, like think about a pie, but I suppose it's a reverse concept. I mean, like each and every, like you have a pie, and the pie is going to reduce as you serve slices. Each and every person, so each and every income statement gets just one slice of that pie, gets just one depreciation expense. But then ultimately, as you serve the pie, as you quote unquote in accounting terms use the pie, the amount of pie is going to be reduced. And so looking at the pie, which is my net book value, you'll be like, oh, I have served the 7 pieces. But then assuming that you don't have, you know, and this assumes that you control for the variable 1 slice per person, but then each and every person got one slice of the pie. So that means each and every income statement got a portion of the depreciation expense. So it's very relevant that you understand the difference between how an accumulated depreciation works and how a depreciation expense works. For each and every income statement year, I'm going to have just one year of depreciation expense. Whereas the accumulated depreciation will show how much have I used so far of that asset, because it's a permanent account. So on that note, and with a lot of enthusiasm, at least certainly on my part, and 3 minutes late, I'm going to conclude class. I wish you guys a wonderful weekend. Try to do something fun and enjoy it. I don't know how the weather is going to be, but whatever it is, if you have to stay indoors, lots of treats and nice hot chocolate. I don't know, that's what I'll do. And otherwise, be outside, have fun, and we'll see you on Monday. Thank you, guys. Have a good weekend.
Thank you.
You.
Thank you.